Hi, I'm Karen Ward.
And I'm Hugh Gimber. Welcome to JP Morgan Asset Management's Markets Explained.
Your weekly briefing, where we cut through the noise and focus on what matters most for investors, setting you up for the week ahead. Okay, Hugh, welcome back. It's the 6th of July, my final week before summer holidays. Trip to Milan in the meantime, so can't quite wind down just yet, but nevertheless, looking forward to that. But lots to discuss today. We're going to go through the big release of last week, which was the payrolls data and how that was pretty helpful for markets. We're going to talk about why the DAX was up almost 5% last week and what's going on in Europe. And then we're going to think about what we'd like our subconscious maybe to work out for us while we're on holiday breaks, or certainly I'm hoping mine will figure it all out for me whilst I'm relaxing. Okay, let's start off then with the most important data release that came last Thursday because of Independence Day, and that is the payrolls release. And just for context, I guess we were worried here, or the market was worried, that if anything, this was going to be too hot, that it would suggest the US economy was really re-accelerating, and that was going to put the Fed under pressure to hike. So what was that release?
Yeah, so basically the opposite story. I think it was good news, this payrolls release last Thursday. There were expected to be around 110,000 jobs added to the US economy in June, and instead we had 57,000, so roughly half as many as expected. Also, some revisions to previous months that made April and May look a little cooler than we'd previously thought. So all in all, this paints the picture of a labour market in the US, which is still perfectly healthy, where if you need a job, you can, have a decent chance of finding one, but not the overheating that's going to force the Fed's hand and encourage them to raise rates anytime soon. So all in all, I think definitely healthy news. Couple of the details that I picked out. Leisure and hospitality seems to be an area which is particularly volatile. It looked really strong in May, maybe anticipation of the World Cup, but then gave a lot of that back in June. So no obvious story there. And I find the 3-month moving average here probably a more helpful measure than getting bogged down in any of the monthly details. And we're now back down to just over 100,000 jobs being added each month on that metric. Whereas this time 4 weeks ago, we thought that was closer to 200,000. So all in all, good news. And the markets responded well as well. So we've seen that the Fed still has just over one hike priced over the course of this year, but that's been pushed slightly to the right. So whereas going into this print, markets were thinking maybe the Fed could be raising interest rates by October, that's now December. So good news, still solid, kind of just right, I think. Not too hot, not too cold.
Goldilocks, lovely. So the S&P was up almost 2%, wasn't it, last week? But absolutely nothing on compared to the DAX, which was up 4.5%. And actually lots of the European markets outperforming. I mean, there are some interesting things going on in European policymaking. In Germany in particular, we had Chancellor Merz outline a whole series of structural reforms. And this is pension reforms, to put the pension system on a slightly more sustainable footing, increasing the flexibility of some of the labour laws, which is a very business-friendly policy, as well as cutting red tape, really looking at business administration costs and lots of sort of crowd-pleasing made in Germany and changing the procurement process, etc. And I think the relevance of this to me, Hugh, is some of the most interesting conversations I have when I'm going around Europe are about my optimism on Europe. I think even with our team, I'm probably the European bull, aren't I? I'm always trying to get you guys revved up about how Europe could outperform. And I think where my optimism comes from is that I believe the perception is that Europe is structurally incapable of growth, that we are just not capable of delivering GDP growth, earnings growth, and for that reason our stock prices are always going to be the laggards, particularly relative to the US. And my view is that it's not a structural incompetence, that actually it's just that we've had really tight policy for the last 15 years. So it's been a long cycle, an ugly cycle, but cyclical. Like it has been caused by very tight regulatory policy, as in Europe, we've been trying to save the planet. Fiscal policy, US debt to GDP has risen 50 percentage points during that period of outperformance. In Germany, the debt level fell 10 percentage points relative to GDP. So we've just been on a much tighter rein, and now the tone has changed in Europe, that there is a much greater, recognition, perhaps, that policy was unhelpful, and an urgency to get growth back. So I find this all part of the story and making me really buzzed up. I'm going to be right on Europe outperforming over the coming years.
I like it. Clearly, you've had your coffee this morning. I guess your point there, Karen, about expectations is key to me, because here we're still talking about a European growth backdrop today, which is relatively muted. But I guess what you're getting at is that for Europe to beat people's expectations, we don't need booming growth. We don't need incredibly strong earnings because the bar is so low.
Yeah, that's exactly it. I think that's one of the mistakes that people often make in investing is they think it's about what happens, but it's not. It's about what happens relative to expectations. Yeah. So, everyone expects the US to always be fabulous, to growth to be strong, corporate earnings to be double digits. That's why you pay 21 times to buy the US benchmark. Whereas compare that to Europe, where, as I say, expectations are we are structurally incompetent. That's why you pay somewhere between, what is the FTSE 100 trading on 13 times forward earnings, or even the DAX doing what it's doing is still only 15 times earnings. I think that really shows their pessimism. That means, therefore, it's a very low bar to beat. So I'm feeling pretty excited about that. I guess another part that could come to the story this week is the NATO meeting. So it appears that Trump is going to join other world leaders as they talk about defense. Do you think that could be market moving this week, Hugh? What are you hearing on that?
Yeah, so we have Trump and Zelensky meeting this Wednesday in Turkey, and this is following a conversation that happened over the weekend between President Trump and Vladimir Putin. I mean, hopefully we get progress here, definitely. But I think in terms of how this would feed into the economic data, it's really the caution from European households, where I think this Ukraine war has shown up most evidently. The caution that European consumers have demonstrated, especially relative to their US counterparts, has been evident in the way that you had this recovery looking pretty healthy back in 2022. And then the spike in gas prices that came out of Russia's invasion of Ukraine really put that recovery to bed. So I hope we'll see progress. I'm not convinced that this week is going to be the week. We've had several of these types of meetings over the past 12 to 18 months where we've hoped to see more than in reality has been delivered. But still, I think the bar here again is pretty low. And so it could well be that we get to the end of this week and we've seen another surprise. So definitely one to keep an eye on.
And I guess in the bigger picture of things we've been talking about before is it all fits into this structural change in the narrative about resilience and how that impactful that could be in terms of regional growth. Because, as we've said before, that for much of the pre-pandemic decade or even the decades before, it was all about offshoring capabilities, offshoring military, offshoring energy, offshoring manufacturing capability. And now wars, energy crises, pandemics, supply chain problems, all of that, and geopolitical uncertainties, being unsure that you can rely on your neighbours that you'd offshored, all of that is seeing this process of reshoring, and defence and military capability is a big part of that story, isn't it? And could be tens of billions of spending.
Big time. And I think that's the other thing to watch this week, because we know that NATO members have struggled for a long time to get defence spending up to 2% of GDP. In recent years, that 2% has been moving towards 3.5% as the expectation for countries to be spending. And now President Trump is saying, well, that's just not enough. I don't want 3.5, I want 5. And so in preparation for this week's NATO summit, the US has been out again saying, European nations have to get to 5% of GDP on their defense spending as soon as possible. It's not good enough just to be laying out a plan for how to get there over the next 5 to 10 years. We know that President Trump wants to see that really now. So I think it would be only natural if some European leaders are heading off to Turkey this week with something up their sleeves so that they can announce greater levels of spending.
Yeah, absolutely. Okay, well, I will be looking ahead to this week, not only for the NATO summit, but of course to my holiday. So I thought,
lucky you.
Yeah, well, I'm going to watch 13-year-olds play football. I should add, my son is 13, so I'm watching a World Cup football tournament, which I'll be honest, is not my perfect idea of a holiday. It generally involves golden sand and a suitcase full of books. But nevertheless, I'm sure it will be lovely. Chance to relax, good time with the family. I don't read workbooks when I'm away. I
Here,
very
here.
much do try and have a complete switch off. But I do find when I do that, actually, my subconscious can be really quite productive. And I'll find I've come back after a couple of weeks believing that I haven't been thinking about work, but yet a lot of things are sort of coming to the surface and resolving themselves. So what I'm hoping that my subconscious is going to crack in the 2 weeks that I'm away are some of the things that's going to set us up for investing for the second half of the year. I mean, we keep coming back to the ultimate question of tech. You know, are we going to discover in the second half of the year that there's even more momentum behind this narrative, that CEOs out there are going to be talking about insatiable demand for these technologies and their willingness to pay for an exponential number of tokens, and therefore all of this back chain of the tech ecosystem is going to look like it's going to be delivering these double-digit earnings forevermore? Is that going to be the story that takes us into year end, or is it going to be, you know, a little bit more sanguine? Might we hear? I mean, the alternative, I guess, Hugh, would be that we start to hear CEOs say, well, you know, we've tried it out. We're going to take a pause now. Do you think that would be the sort of risk in the second half?
I think that's right. And I hope that we'll have some of those answers by the time you get back, to be honest, because we have Q2 earnings season kicking off over the next few days. I'm going to be digging into this on the pod over the next couple of weeks with some of our investors from across the business. And that, for me, is the really key area to watch. Spending less time listening to the tech companies themselves in telling us what they're seeing, and really focusing on what CEOs and CFOs outside of the tech sector are feeling about how much they're spending on this technology. And really coming back to that killer question: is the productivity, is the earnings growth that they are able to generate from their spending on technology worthy of them continuing to double down on future tech spend? Because for the hyperscalers to see strong enough demand in future, and for the model providers to see strong enough demand, we still need a greater flow of cash basically coming from outside of the tech sector, with companies being willing to invest in their technology setup and really doubling down on the use of some of these tools. So I suspect that's where we're going to be spending a bit more time whilst you're away, trying to really drill down into what we're learning from companies outside of tech.
Okay, well, let's hope my subconscious adds to the actual work that you're doing. That sounds brilliant. I guess the other thing I'm going to be thinking about is then beyond tech, and where might be some of the not only winners from the technology story, so who are going to be the industries that make most use of these new technologies that are perhaps not being recognized in market prices at the moment. And then just more broadly, that rotation story. Is that where we're headed back to? If we think about last year and then the first 6 weeks of this year, it was all about rotation. It was rotation out of tech, rotation across geographies. And that got paused when there was the conflict in Iran. But is that what we're returning to in the second half of the year? And again, what are we going to learn over the summer months that might tell us that's the best way to be positioned for H2?
And I think that's where this earnings season is going to be really interesting, because if I take us back to mid to late April, we were right in the thick of that conflict at the time. Oil prices were surging, and therefore companies were very reluctant to offer any kind of guidance about the coming quarters, because they simply didn't know whether they were dealing with a world of oil at 120, 150, 75, and yet here we are today with oil prices basically down at $70 a barrel. So my hope is that CEOs will be a bit more forthcoming this time round in painting a clearer picture of where they see their businesses headed.
Yeah, absolutely. And I guess the other thing we might get a little bit of information on while I'm away is who Andy Burnham might be selecting for his cabinet. Now, maybe that comes just on the day I get back, but I guess exactly how he's going to flesh out those ambitions that he's set himself. I mean, when we last spoke, we hadn't seen the speech, so he's set out clearly a big devolution agenda, a skills agenda, a social housing agenda. I mean, none of that is new. The problem has always been about funding, major change. And so that's what I think the markets are going to be looking for. Any signs? Does he think he's going to be borrowing to pay for this? Or is this going to be yet again lots of talk and not a lot of money and not a lot of action?
One thing that caught my eye this weekend, Andy Burnham is backing rugby league. Might have passed you by at the weekend, but he was at the big games with a microphone in hand on the pitch talking about his commitment to Northern sport. So if that wasn't on your subconscious already for your holes, Karen, I'd suggest that also sneaks on the list.
Well, I've got enough. As you know, I live in a football madhouse. We're not allowed to discuss the sports that have the wrong shaped balls, although maybe I'm losing half of our audience with that declaration. But on that note, we should say, of course, the other big thing that's going to happen is the quarterfinals, and it's coming home.
Bring it on.
I won't see you for the next couple of weeks, but as you hear, Hugh's got a special guest that are going to be joining him. So definitely keep up with that. And if you can, like, share, subscribe, all these things that you do, we would be very grateful. And if you're heading off on your summer holes, wishing you a lovely, peaceful time.
This communication is educational in nature and not designed to be taken as advice or a recommendation to buy or sell any investment or interest thereto. It is based on assumptions in current market conditions and are subject to change. It should be noted that the value of investments and the income from them may fluctuate in accordance with market conditions, and investors may not get back the full amount invested. Past performance, yield, or forecasts are not a reliable indicator of current and future results. JP Morgan Asset Management is the asset management business of JP Morgan Chase & Company and its affiliates worldwide.